Hello there. In this video we're going to see some case examples of what reversal formations as per the candlestick formations we've been seeing on a previous video, what they actually look like on real forex charts. Alright, so on this first slide we are looking into the euro against the American dollar, a daily time frame. As you can see, price has been nicely downtrending for quite a while. Alright, well, price giving us nice swing downs with the consequent retracements, another swing down, another retracements. Actually, let's do an exercise here. I think it's going to be interesting. Let's analyze this chart as if we were looking into it in real time. All right, so price gives us a swing down and a retracement. Our job as a trader is to mark the the resistance lines on this particular trend, isn't it? So we mark the final swing low being now support, and also the final swing high being now resistance. Right, there we are. Okay, that's our support line in this final swing, in this trend, and that's the last resistance line as per the retracement of the last swing. Right, now price takes off on a whole new swing to the downside. Do you see that? First swing, then second swing. So what's our job as a trader is, well, we just need to readjust. That's what we do on those 10, 15, 20 minutes. We monitor our charts per day. We simply readjust our support and resistance lines if we do need to. If we don't have to, we just leave them as they are. All right. Eventually, price takes off. Let me scroll forward a little bit. Eventually, price takes off in a whole new swing to the downside, breaking through the previous support level. So what do? We readjust this support line once again. All right, let me actually extend that. All right, price gives us another pullback. Okay, this is the previous swing, then we have a whole new swing with a pullback, actually quite a long pullback, coming back to retest that resistance line there, the previous resistance level. Okay, whoops, let me scroll forward. So we extend that. Actually, it comes to retest it right to the peak. Whoops, just a second, guys. I don't want to be sloppy with my lines. It comes back to retest that right to the peak. It respects, all right, finds a reaction of that level, and it takes off, and to the downside. And well, this line is not being retested, so it's still valid. We need to keep on extending that in time. All right, another attempt to break through that level, isn't it? And let me just extend that. As we can see, price. There we are. Oops, sorry about that. Just a second. I really like to be accurate with my trend lines. Anyway, price comes back to retest that level once again, and what do we get? Well, hell, that's isn't that a hammer formation, an inverted hammer formation? Remember that a hammer formation looks like this, and an inverted hammer looks like that. All right, with a long wick to the upside, short body, and a short wick to the downside. That's exactly what we have here. That's actually, let me zoom in a little bit more. That's exactly what a hammer looks like on an actual forex chart. There we are. All right, long wick banging onto that particular level, not being able to breach above. Immediately after, we get reaction, and price comes back down to close more or less at the opening level. All right, at any rate, we get a small body, green color. Like I said before, the color of the actual bodies doesn't matter. What do we get from there? A momentum bar, momentum move to the downside. All right, the consecutive, or actually the bar immediately following the hammer formation is a momentum bar in the opposite direction after this reaction. Please mind how this is a full body long candle, all right, with hardly any hesitation, short wicks both up and down, full body, and therefore this reaction is happening in volume, is happening in momentum, and that's where you want to make your profits. All right, entry as usual. There you are. The conservative way of entering the trade, it would be to wait for the actual breakout of that candle. The aggressive way would simply, enter in the trade as the pin bar closes, meaning the open of the new bar right there. But again, if you are more or less conservative, somewhat conservative, you want to simply, well, enter the trade 5 pips below the low of that pin bar. All right. Stop loss, conservative way, up there. Aggressive way, 50% of this bar. I mean 5 pips above the 50% range of that bar, somewhere in there. Right. Entry, stop loss. As this bar closes, well, that's where you want to exit 50% of the trade. All right, and you simply trail your stop loss to break even. And then on the next candle, as you can see, it's a little bit smaller, actually significantly smaller than the previous one. This rejection momentum is dying out. You cannot expect momentum to keep on pushing forever, right? That's why the first one is usually larger than the second one. Okay, that's been my experience after so many years of trading. The first momentum bar is always larger, usually larger than the second one. So you close 50% of the trade there. You close the remaining 50% of the trade there at the close of this second bar. All right, pretty prototypical price formation. Okay. Oops, sorry about that. Let me zoom back out once again. Like I say, prototypical hammer formation there of a level of resistance. All right. Actually, as I look into my chart, I am seeing some sort of a. I actually didn't spot this as I was recording this video before. Don't we have some sort of a railway track there? You see, as price approaches to that level, we have a long momentum bar, but just immediately after, we have an equally long or almost equally long rejection bar. Therefore, that's that clues us in that we have plenty of selling pressure building up at that level, and therefore the rejection happens in momentum. Entry there. We close 50% of the trade there. Stop loss 5 pips above the 50% range of this bar, which is somewhere in there. Right? At the close of the profits in there, at least 50% of the profits, we simply trail the stop loss to break even, and then we close another 50% of the trade in there. Okay? Funny that we found 2 consecutive reversal formations in this particular setup, in this particular chart. Alright, let's review another example, also on the euro against the American dollar, daily time frame. As you can see, nice uptrend. Let's keep on drawing our levels of support and resistance in this trend. Swing up, swing down, resistance in there. Price comes to retest that level. Do we get any do we get any type of reversal formation there? No, price simply pushes through, right? So no reversal formation. Another swing up, another retracement. Let's draw resistance in there. Do we get any reversal formation the next time around? No, we don't. Price simply breaches through. All right, it's a breakout move, so no reversal there. Next swing up. There we mark it. Our job as a trader is to keep readjusting our levels of support and resistance, isn't it? So price comes up there. What do we get? A breakout or a reversal? Actually, price breaks through the previous level of resistance. So, no trading opportunity there. And then it just takes off on a massive swing to the upside. So eventually, it gives us a new resistance point there. We draw our level of resistance. Let me actually draw it with a market with an actual trend line, horizontal line in there. All right. And next time around, next time price comes to retest that level, what do we get? Do we get a breakout or do we get a reversal? Well, let's zoom in a little bit more for a clearer picture. There it is. We actually get a pin bar. Pin bar, guys, there. Small body, long wick to the upside, being at least twice as long as the actual body, or any type of wick to the downside. In fact, this time around we don't get any wick at all. Right? What's important here is to see how price gives us a long wick to the upside, banging onto that particular level, and from there, momentum move, and then another momentum move, or at least, well, certainly smaller than the previous one, but like I said before in our previous video, that's usually the case. This time around, we actually got 3 momentum moves to the downside. That's usually not the case. That's expecting a little bit too much, right? That's again, wishful thinking. You want to be conservative with your trading, so shooting for two momentum moves in the opposite direction of the bounce is usually the norm. All right, so reversal formation right off a level of resistance. We are okay to search for our entry there, stop loss in there or in there, depending on whether we are aggressive or not. 50% of the trade there, simply trail your stop loss down at that level and cash out a portion of the trade, and then on the close of the next candle, close out the remaining portion of the trade. As you can see, pretty prototypical stuff. These kind of things happen over and over and over and over. All right, so again, prototypical stuff. All right, are we ready for another pin bar, for another hammer? American dollar against the Swiss franc, daily time frame. Nice push up. Finally, price stopping out at that level. All right, let's mark it with a horizontal line. Let me carry this line all the way up there. And what do we have next time price retests that level? Pin bar formation. There. Pin bar reversal formation. You know what to do. Search for trades in the direction of that market reaction to the downside. Plenty of bars actually here. 1, 2, 3, 4 bars. Heavy momentum up on that bounce. All right. As you know, I wouldn't bet for more than 2, but nonetheless, nice reaction of that, or as a consequence of that pin bar right off a previous level of resistance. Actually, if I scroll forward a little bit here, we see support the double level of support. We extend that line. What do we have there? That's a fake breakout taking the shape of a railway track. Okay, two twin bars, equal in size but just different colors. Right? Basically, fake breakout in one direction. Price reverses, and as a consequence, momentum bar. Right, momentum trade in the opposite direction. Do you see this long green bar to the upside in the opposite direction of that fake breakout there? Right? I don't really want to talk too much about fake breakouts. We will see another video very shortly. But well, just to tickle your curiosity, you will see how that's a railway track that seems like it's going to break in one direction. Immediately after, it gives us the reversal, and from there, bang, nice trade in the opposite direction. All right, let me now show you an example that's not perfectly clear. Nonetheless, it's still a valid reversal formation, but it's not an ideal one, and you will very soon see why. We are looking into the Swissy again, American dollar against the Swiss franc, daily time frame. Price has been pulling some swings up, some swings down, some swings up, some retracements down, so on and so forth. Eventually, this trend line gets broken, okay? And now we begin simply zigzagging down, okay? Again, our job as a trader is to mark levels of support and resistance. But if you remember from a previous video, we don't just draw horizontal levels of support and resistance. We also draw trend lines, don't we? Let me actually draw the trend line with an actual trend line in itself. All right, there we are. Now, swing down, retracement up. Swing down, retracement up. Doesn't quite touch that level, so we cannot really base any bounce off that level. Price takes off on another swing to the downside, another pullback. This time, price does indeed come to, let me zoom in a little bit more. This time around, price does indeed come to retest that trend line, okay, that diagonal level of support and resistance. What do we get? Well, we get first of all, we get a pin bar. I hope you guys can see that pin bar with that long wick to the upside. The body is a little bit long for my taste. This is the ideal pin bar formation, right? Short body, short wick to the downside, and long wick to the upside. But at any rate, well, we do have that long wick up, retesting right to the peep that trend line. But also, if you notice, this is an outside bar as well. See how the high for that bar is higher than the previous bar's high, and the low of that bar is lower than the previous bar's low. So that's both a pin bar and an outside bar happening right off a level of resistance. Therefore, even though it's not mint perfect, it's still a valid reversal formation happening at the right location in the chart, meaning right off that trend line. Now, here's where things get well, not so perfect, so to speak. The next bar triggers our entry. If you remember, we place our entry 5 pips below the outside bar in itself, okay, the reversal bar there. It triggers our entry, but we don't quite get a momentum bar. Price takes just a little bit longer to begin pushing in our direction. At any rate, see if this is the bar in itself, the bar range, that's the 50%. That's where we place our stop loss, 5 pips above the 50% range of that bar. Well, at no rate, price at any time comes to challenge that stop loss placement. But like I said before, ideally you want this bar, the trigger bar, to be a momentum bar. That doesn't quite happen. We get some sort of a sandwich bar. Remember before where I was mentioning that on occasion you do get sandwich bars? Well, this is one of those cases where the momentum up on this swing, especially up on this reversal, does take a little bit longer to take off. Eventually it does, all right? Eventually it does. But again, not an ideal location. I just picked this example to show you guys that on occasion you do get those hesitation bars, and you've got to deal with them as long as you've placed your stop loss at the right area, all right? At the right area, you should not, more often than not, price should not challenge, even though we see that hesitation there, price should not come up to challenge that stop loss level, all right? And eventually, well, it does take off in the direction of this bounce. Okay, another example, also the Swiss C weekly time frame. Nice move down, giving us finally a final level of support. All right, and a level of support, price retraces up. Okay, gives us a level of resistance, price comes down, and well, it comes to retest that particular level. What do we get there? Let me zoom in a little bit more for a clearer picture. That's the former level of support. What do we have there? Well, we have a railway tracks, don't we? You see those two twin candles, equal in size, equal in length, more or less, and just different colors. Okay, banging right off that previous level of support, and from there, well, one up move. The next candle after the trigger bar, obviously that would be the entry, that would be where we close a little bit of the trade. Well, the next bar, as you can see, didn't quite give us any profit whatsoever. Again, that's something that happens. Okay, the first rejection bar, or the first momentum bar up on the rejection, is where most of the trades are to be made. Right, is where most of the trades are to be made. The second one is just something that we just leave open because occasionally it does give us some further profits. That doesn't always happen. That's why you want to move the stop loss to break even as you cash out a portion of the trade at the first target. All right, but anyway, at any rate, as you can see, ideal railway track formation of a level of support. Okay, now let me show you another example on the Australian dollar against the American dollar weekly time frame. Actually, the last trade I took using these strategies. Nice run down. All right, eventually wears out this downtrend. We begin seeing an uptrend. Okay, let's assume we are monitoring this trend in real time. This is our level of support. Price gives us a full swing to the upside. We mark the latest level of resistance, another level of support there, so we mark it. Price comes to retest that level, we get a breakout, price keeps on pushing on a whole new swing, so we mark it there. So far we have these two levels marked in our chart. Price gives us another swing down, we mark this one there, and we also have this one from the previous swing high. Alright, so let's actually mark it with a straight line. There we are, and also this one here. Right, seems like price is now retesting as I record this video that level. Anyway, let me now zoom in a little bit. What happens next time? This is the last swing I was talking about before, and this is the pullback, okay, the retracement. As we can see, price had found resistance of that particular level a number of times. Do you see how 1, 2, 3, 4, 5 different bars topped out at that particular level? Do you see that? Well, We have the retracement, we have a pullback. What happens when price retested that level once again? It gave us, what's that, guys? You're probably familiar with this already from the previous video presentation. That's a spinning top, right? Spinning top. Small candle with a small body and short wicks both up and down. The color is, it's meaningless. It doesn't really matter, all right? Basically, what this signifies, spinning top signifies confusion or hesitation. Price comes to retest that level. We don't quite get any momentum, okay? We don't quite get either a breakout or a full bounce. Simply price stops to a, comes down to a halt, to a stop, and from there, well, we are to take a decision as a trader, right? Are we going to be, since price seems to be respecting that former level of resistance, okay, the previous swing high with those multiple touches, all right? Are we to search for our reversal formation? If we are, well, we need to understand that we are going to take an aggressive trade, okay? Since, again, we are not quite seeing that heavy momentum bounce. Okay, here we actually got an outside bar now that I look at it, all right? An outside bar. And, well, this time around we don't quite get that, all right? We just get a spinning top. So if we take our entry right there as the spinning top closes, or down here if we are a little bit more conservative, our stop loss needs to be placed up there. Do you see how this wick would have stopped us out if we placed the stop loss around the 50% range of that bar? Do you see that? Okay, with that wick there. Again, please mind that spinning tops or dojis are small bars. You cannot really tighten up your stop loss too much, okay? Any random wick, any random wiggle in the chart will simply stop you out, okay? So if you are trading reversals of spinning tops, dojis, or inside bars, okay, an inside bar is a bar like this, alright, this being the inside bar totally engulfed by the previous bar. Well, if you take this type of trade, you need to stretch out your stop loss just above the high of that spinning top. Okay, and well, eventually one nice momentum to the downside, and then the second one. As you know, I like to bet for 2 consecutive momentum moves in the direction of the bounce. All right. As you know, I like to be a little bit more aggressive with my exit policies whenever I am trading low quality setups such as spinning tops. Okay, so what I did, I simply closed out 66% of the trade at the close of the first bar, and then 34% of the trade at the close of the second bar. Okay, and obviously I cut down a little bit on my trading size. So just trade less heavily on low quality signals, and also be more aggressive with your exits, trying to cash out to secure portion of a large portion of the trade as soon as possible. All right, now I want to show you a setup that I'm still banging my head against the wall out of this one. I should have taken the trade, and I didn't. I missed the opportunity, but at any rate, I'm gonna let you know the reasons as of why I was considering taking this trade. Anyway, American dollar against the Canadian dollar weekly time frame. All right, as we can see, we have a nice level of resistance in there. In fact, we have some. Take a look what we have there, right? Right off that previous level of resistance, we have an outside bar, right? Nice outside bar with this, the second bar totally engulfing the previous one, and from there, bang, momentum, okay? Outside bar, just right off a level of resistance. This is a valid trading opportunity, but this is not the one I want to talk about. The one I want to talk about is the latest one. I mean, one that's happened this very month, and I didn't take it. Anyway, former level of support there. Another former level of support in there. Price comes to retest. So basically what I'm getting down to is that we have long-term heavy support around that level. Price pushes another swing to the downside. Alright, it comes down to retest that level once again, and what do we have there? Actually, let me zoom in a little bit more. What do we have there? That's a doji. You see that? Oops, sorry. Just let me actually mark it with a straight line. Alright, there we are. former level of support, we get some sort of a pin bar or a hammer reversal formation, 1 and 2 momentum bars in the opposite direction, pretty typical stuff. Anyway, price comes down to retest this previous level of support, also coming from, well, quite a long time ago, and it gives us the doji. The reason as to why I didn't take that doji, do you see the small bar? Alright, very small bar. Actually, the body is just a line. The reason as to why I didn't take it is because the wicks on that particular doji were too long for my taste. And first of all, not only it's not a pretty doji, you want dojis to look like, I don't know, let me try to scroll back, see if I can find any doji. Alright, this is a valid doji right there. Do you see that? Very, very tiny body, tiny body, and then short wicks both up and down. That's a valid doji. Alright, so here, well, that's not the case. Alright, and we do have long wicks both up and down. Okay, but at any rate, I mean, still, you know, hesitation, price does respect that level, that former level of support. The reason of why I didn't take it is because it wasn't efficient from a money management point of view, and here is why. If my entry was there, alright, and my stop loss was there, this stop loss was just a little bit too long for my taste for a low quality setup. Again, please remember, spinning tops, dojis, inside bars are low quality setups, and the stop loss here in this one was just a little bit too long, again, for a low quality trade. Alright, for a low quality setup. If the doji was just something like this, alright, something like that, and that was my entry and that was my stop loss, well, that would have been an okayish, you know, okayish stop loss size, and you know, I could have gone for that one. Okay, I would have taken that one. But again, I mean, this is quite a long stop loss. Even if we do have a momentum reaction, which we did, again, do you see here how the second bar is a little bit smaller than the first one? Okay, do you see how this one is shorter than this first momentum bar? That's usually the case, guys. Anyway, even if we did get, which we did, by the way, a momentum bar, by the time I closed that trade, if that was my entry and that was my stop loss, as you can see, the distance from my entry to my exit is smaller than the distance from my entry to my stop loss. That's usually not a good idea, especially on low quality setups. Okay, when you don't quite have that massive win-loss edge in your trading. All right, that's that profitable win-loss ratio, by definition, you know, low quality setups will yield a lower win-loss ratio over time. So I decided not to take it. Again, from a money management point of view, not only this doji is a little bit ugly with those long wicks, but also, like I say, from a money management point of view, I don't know. Just you know, it's just risking too much for too little on that first target. So not my cup of coffee, and I just let this one go. As you can see, it was indeed a profitable trade. Okay, but sometimes you need to let go on some occasional trading opportunities if your money management rules just don't fall in line. All right. Actually, that was not a one-off event. As you can see now, I'm going to show you another recent example of a trading setup that, again, happened very recently, and I opted out. You know, I decided not to take it precisely for the same reason. Australian dollar against the Canadian dollar, double level of resistance. All right, so effectively we have a double top in there. If we extend that line, we can see how. Actually, let me mark it with a straight line. Just give me a second, guys, here. All right, there we are. Whoops. Okay, next time price came to retest that particular level, if I zoom in a little bit more, you will see that long spinning top, right, with long wicks both up and down. And again, that's another reason as of, you know, that's precisely the reason as of why I didn't take that trade. Okay, we had a nice run up to retest that level. We saw a little bit of a breakout. Maybe that could be you know, that would fall in the realm of fake breakouts, which we will see on a future video. But at any rate, please mind that long spinning top, that I am rather hesitant to try it. Okay, from a money management point of view, again, if that was my entry and that was my stop loss and that would have been my first target, as you can see, it's not really any it's not something worth taking. All right, long stop loss for potentially for small profits in there. So once again, a clear example as of why you want to be very selective with your setups. Okay, cherry pick only the very best ones. No need to trade here every day, guys. Just 3-4 trades a month is all it's all you need. Okay, let's take a look now into something that doesn't quite happen. Okay, doesn't quite happen very often, but at any rate, whenever it does happen, you're gonna get some fantastic reversal opportunities. I'm talking about the double hammer formation. All right, basically what you get is not only one hammer right off a level of support and resistance in this case, but immediately after you actually see another hammer. Okay, some sort of a twin hammer formation, and this is a fantastic reversal opportunity. All right, price tries to break through that level once, it fails. Price tries to break through yet again, it fails once again, and as a reaction, once the market as a whole recognizes that as a double failed breakout or a double failed attempt to break that level of support and resistance, you usually see quite a nice momentum in the opposite direction, as again the market as a whole recognizes that as a as a breakout that's just not going to happen, and everyone and their sister begins to click on the respective sell buttons. Alright, anyway, what are we seeing here on the Canadian dollar against the Swiss franc? A nice uptrend in a scenario. Alright, price pulls, swings in the direction of this uptrend, giving us a resistance and a support point. Another swing to the upside, giving us another resistance and another support point. Yet again, another swing in the direction of the trend and another pullback, etc., etc. Okay, so effectively what we have here is this final level of support. Let me actually mark it with a line. We actually get that one of those dojis that I'm not too fond of, one of those long dojis there. You see a small body with long wicks both up and down off a level of support right there. Okay, and then 1 and 2 consecutive moves to the upside. They do happen, guys. They do happen. I'm just not too fond of trading them from a money management point of view, as you already know. Anyway, so we have our support level, and now we have another resistance level, don't we? So let's mark it up in our charts. All right. Okay, let's mark it up there. Now, as the chart continues to develop, price comes to retest that level there, and what do we have? We have a hammer formation, don't we? Right off that particular level of resistance. Okay, right to the peep. But lo and behold, what do we get right after? Another hammer, another twin hammer. Or, well, as a whole, both of them could be combined into one single reversal formation, a twin hammer reversal formation. And as you can see, they are both more or less equal. The small bodies at the bottom end of the candles, small wicks to the downside and long wicks to the upside, retesting right to the peep that previous level of resistance, and effectively failing twice to break above, and obviously common sense says that the next immediate move is going to be to the downside. We do have our momentum bar, right? Long, thick bar with a long body, hardly any wicks both up or down, and then we have yet another one. All right, yet another one. As usual, I like to bet for 2 consecutive moves, and then, well, momentum begins to fade away out of these reversal moves as usual. Okay, you guys know that. As usual, you can bet for 2 of them, no more than that. Don't get greedy searching for yet a 3rd candle. All right, but anyway, what I wanted to stress in this video is how we are getting that twin hammer. Again, it doesn't happen very often, but whenever it happens, it's a fantastic opportunity. All right, obviously that would be our entry, just 5 pips below the second hammer. Our stop loss 50% above the 5 pips above the 50% range of that second hammer, 50% of the trade there, and another, 50% of the trade is closed there, and then the remaining 50% is closed at the close of the second candle. All right, well, we've seen quite a few examples already, isn't it? As far as reversal patterns goes, I don't want to bore you guys. You already get the hang of it. You already, get the picture. You know what to do. Just keep on drawing those levels of support and resistance, wait for price to retest those levels, okay? And then simply see whether you find or you recognize any reversal patterns out of the few that we've listed on a previous video, right? If you don't quite find the reversal that you were expecting to see, don't take that trade. Simply wait. Just wait a few more days, 1, 2, 3, 4, 5 days, and up on the next level, you may indeed find your trading opportunity. You don't have to take trades every single day again, right? This is all about being selective. If you don't find a trading opportunity right there on the Canadian dollar against the Swiss franc, don't you worry, there are 28 currency pairs. And trust me if I say that chances are that sooner or later, if it's not today, it's going to be tomorrow. And if it's not going to be tomorrow, it will be the next day after. At any of those 28 currency pairs, you will recognize those reversal formations right off key levels of support and resistance. Okay, so again, this is pretty simple stuff. Just keep on drawing as accurately as possible those levels of support and resistance, and keep monitoring price action around those levels. Trust me if I say that once you get the hang of it, you will find trading opportunities more often than you would think. Okay? Alright folks, that's all for this video. Bye-bye. Hello there, Hector the Bill here. Today we're going to be looking into fake breakout formations, okay? Which is basically a reversal formation disguised in the shape of a breakout, okay? That's why it's indeed a fake breakout. Price seems like it's going to break through in one direction, but immediately after it just turns around and, well, off it goes in the opposite direction. Now, basically the patterns that we're going to be reviewing as fake breakouts are exactly the same as the reversals themselves, okay? Since again, I must repeat that a fake breakout is a reversal disguised in the shape of a breakout, but a reversal nonetheless. All right, so while we can find fake breakouts taking the shape of hammers, railway tracks, outside bars, etc., etc., in order to not overstretch this presentation, I'm just going to pick the hammer formation and I'm going to explain the fake breakout formation. Again, just taking the hammer as a case example. But again, you can absolutely apply exactly the same principles to also railway tracks, formations, outside bars, inside bars, etc., etc. I'm just going to, for the sake of simplicity, explain the whole thing under a hammer or pin bar, and again, you can simply apply the same principles to all the other different candlestick formations. Okay? All right, let's get started, and I'll be waiting for you on the next video. Well, all right, let's get started with the strategy we're going to be reviewing today, the fake breakout strategy. This particular trading technique, methodology, is based around price reaction, okay, price action reading around key levels of support and resistance. Obviously, in order to have a breakout, first of all, you need a level to break out from, right? It doesn't matter whether it's a valid breakout or a fake breakout. Either way, you need a reference level, all right, to search for this type of price pattern around that level. That level obviously is going to be support and resistance, either a horizontal level of support and resistance or a diagonal level of support and resistance. Most of you will probably know diagonal levels of support and resistance as trend lines. So it's basically the same thing. So again, we can apply this strategy on either market scenario, okay? Either a horizontal or diagonal level of support and resistance. Now, what's a horizontal level of support and resistance? Well, let's assume price is moving on its, on its typical zigzagging formation. All right, let's assume an uptrend. Well, price eventually pulls a final swing high. All right.
we can obviously define a horizontal line around that final swing high, and therefore we have a level of resistance since price is below that particular level. Okay, price pulls back from that final swing high, and well, it attempts to take out on that level of resistance. It comes back up to retest that level, and once price reaches that particular level, there are three possible outcomes. All right. First of all, we can have a valid breakout if price does push through that level. Second, we can have a bounce reaction, all right, price respecting that level, and from there finding resistance once again, forming what's usually called in the forex lingo or in the trading lingo a double top. All right. Or the third outcome is a fake breakout, in which price seems like it's about to break through. All right, probably many traders will be tricked into clicking on their respective buy buttons, okay, and go long at that precise moment. But sooner or later, actually more sooner than later, price, fails to keep on pushing through and eventually turns around, and well, all those people who scored or who clicked on their buy buttons, who went long as the breakout was beginning, or as price was beginning to tick above that resistance level, well, all those people score unfortunately a loss as price again reverses and finally gives us a fake breakout. That's the type of outcome we're gonna be talking about today. We are not gonna talk about valid breakouts. We are not gonna talk about bounces. We are gonna talk about fake breakouts. We are gonna leave the other the other possible outcomes for another video. All right, for another day. So. Obviously, the same holds true if we are, if we would be looking into a trending scenario, right? We have our typical trend line, marking the resistance level. In this trending scenario, price pulls back, retraces to retest that level. Again, we can have a valid breakout and therefore the trend as a whole is finished. We can have a bounce and therefore the trend is still in place as long as this trend line is respected. Or we can have a breach of that trend line, a temporary breach of that trend line, just to see price again turning around right away. That's again the type of condition we're going to be talking about today. The price pattern, the price behavior, we're going to be reviewing on the following minutes, is applicable, again I must stress this, applicable either on horizontal levels of support and resistance or trend lines. Just for the sake of simplicity, I'm going to base this video, this presentation, around the horizontal level of support and resistance. All right, but again, you can find this pretty much exactly the same type of price patterns also in trend lines. All right, just because I'm gonna, for the sake of simplicity, base the entire presentation around horizontal levels, please don't be scared if you find the same price pattern on trend lines, because I must repeat, you can also trade it in the same way. All right. Let me move into the next slide presentation. I'm using a PowerPoint presentation here, by the way. So. Again, this is our typical zigzagging formation. Price pulls a final swing high. We can draw our levels of resistance, in this particular case based around that one. Obviously, on this swing there, we would have done exactly the same thing. This time around, what did we have? We get a valid breakout and we didn't get a fake breakout, did we? So we are not going to be searching for that type of price pattern around that level. So we have our final swing high. We draw the top level of resistance for this particular trend, and now we're waiting for one particular. Next time price comes back to retest that level, we're going to be waiting, or we're going to be searching for a particular trading for a particular price pattern around that level, in order to determine that the breakout is in fact going to turn around. So we, first of all, we are not going to be fooled or tricked into going long as the breakout goes through, and second, we are going to make our profits as the reversal, all right, as the reversal price formation begins to appear on our charts. Okay, just aiming to make profits from the reversal move. Okay, so we are going to have two goals with this strategy. Again, Number one, to not get tricked or to not get into a losing trade right away as the breakout begins to, or as price begins to tick above that resistance level, and second, to make our profits actually on the reversal move. Okay? Anyway, before I actually show you guys the actual price pattern we are going to be trading today, before I teach you about the entry point, where to place your stop loss levels, where to place your profit taking levels, etc., etc., we are going to be, or I'd like to talk just for a minute or two about market psychology. Okay, why fake breakouts occur, and why do they occur so often? Okay, they do happen very often. Around between 40 and 50% of all breakouts, in my experience, end up being fake breakouts. They happen very often. Why do they happen so often, and why do they work in such way? All right. Basically, I'm going to talk about the nature of the fake breakout strategy. So next time you are trading this particular trading technique, okay, you are familiar with the market mechanisms that move price in such a way. All right. You've probably heard, by the way, this is going to be a little bit of theory, all right? Please bear with me with the theory mambo jumbo here. It's going to be fun. It's going to take just 2 or 3 minutes, and again, it's going to give you a much deeper understanding of this strategy as a whole, okay? You've probably heard that the markets are moved by fear and greed, correct? Fear and greed is what make any speculation market, be it forex, be it oil, be it stocks, future, anything, right? Any type of market is moved by fear and greed. Well, that's actually true, by the way. Uptrends, such as in this case, uptrends or downtrends, any type of trending scenario, are usually spurred or fueled by greed, okay? How is that? Well, let's assume in this case we have an uptrend. Well, price keeps on pushing in one direction because as long as price signals that the trend is still in place, more and more traders around the world are looking to buy into this uptrend. Okay, basically they are looking to add or to enter into this uptrend with the goal of making money as the trend keeps on moving price into one single direction. All right, they say the trend is your friend, and therefore more and more traders are looking to make money out of that trend by simply keep on buying or adding into that position. All right, they fuel the trend by adding positions into that trend. Okay, well, counter trend moves, in the other hand, are moved by fear. All right. Let's see how I explain this. Let's say that people are looking to make money out of the trend as long as the trend stays in place. But once the trend, let's assume we have a trend line there. Once the trend line breaks, okay, once the trend gives way, the fear in the market, all those people who were going long, fear that they will lose their profits. Imagine you enter long, I don't know, after this pullback, okay? You enter your buy position there. At this point, well, you've made quite a healthy profits, but as price breaches through the trend line, as the trend comes to an end, that guy, those traders that entered there, are not so confident anymore in their position, all right? They are beginning to fear that they will lose their profits, all right? And therefore, they are very hasty, very quick to close that trade. All right? As long as the trend is in place, greed is what moves those traders. As soon as the trend gives way, fear is what moves the decisions from those traders. So, as long as the trend is in place, they aim to make money. They out of that trend. Once the trend gives way, they fear they will lose those profits, and they are very quick to cancel, to reverse their positions. All right, that's why trending scenarios usually move in a milder fashion than counter trend moves. If we were to draw an angle on a trend, we would see that the angle on a trending scenario is much milder, right? Not so steep as counter trend moves, okay? Because again, counter trend moves are fueled by fear. And I reckon probably the psychology behind this is that people are more afraid of losing money than they are keen on making it. I hope I'm making myself clear, right? People are more afraid of losing whatever money they have, that they are willing to make more money than what they already have. All right, so if you had a profitable position right there, your number one fear is to lose those profits you've scored here than to keep on making new and higher and higher and higher profits. All right, your number one priority is to not lose the profits you already have. Again, that's why as soon as the trend comes to an end, as soon as the breakout takes place, they are much quicker to close that position than they are to keep on adding into that position should the breakout take place. All right. This is very important. Market fear and greed is what moves the market, but fear is more violent, more volatile than greed in itself. All right. Anyway, why am I telling you all this? Why am I getting so heavy on greed here and fear there and market psychology and blah blah blah, all this kind of stuff? Well, the reason for that is because the strategy we are going to be talking about today is, well, it's entirely based on fear and greed, okay? And, well, more specifically, on how that initial greed that takes place as price begins to break out is completely overwhelmed by fear as price actually turns around, okay? All those people that begin clicking on their buy buttons there, how fear overwhelms their greed, and therefore how price accelerates in the opposite direction. Okay, important to notice how price accelerates, acceleration, all right, market momentum in the opposite direction. I'm stressing this because we are actually going to make our profits as price accelerates in that opposite direction. All right. Please, guys, mind one particular thing. Let's assume price begins to tick above that level. Many people are tricked into believing that the breakout is taking place, and they click on the respective buy buttons right there. Okay, they enter. You, for example, you or me, we enter, I don't know, 10 lots of the euro against American dollar. All right, 10 lots. Obviously, 10 lots do not move the market, but if hundreds upon hundreds upon hundreds of traders enter the market with 10, 50, 25, 3 lots, whatever, whatever the case might be, all that combined is what actually moves the market, okay? Especially if we are talking about large traders working for, institutional banks, investment funds, all those kind of people entering trades with hundreds of lots every single position. All right. Anyway, but just to make it more personal, let's assume I entered the trade with 10 lots of the euro against the American dollar right there. Okay. I am all happy and cheerful about seeing price moving in my direction, but sooner or later, again, probably sooner than later, price begins to turn around, and I am feeling the sweat. Okay, I'm beginning to feel the heat here, and as price comes back down below that level of support and resistance, I either close my trade or at a loss, obviously, or my stop loss is hit. Okay. Now, there's one key thing that you've got to understand here. In order to close a position, you need to reverse that position. Now, those 10 lots I bought from the market, if now I want to close that position, I need to sell those lots back to the market. All right? Is that clearly understood? I mean, that's obvious. If I bought an asset from a speculation market, if I want to cancel or reverse my position, I need to sell it back to the market. All right? That's obvious. That's no secret in there. However, When I was buying 10 lots here, I was creating buying pressure. Okay, I went to the market and I say, hey guys, I want to buy 10 lots. I was actively creating buying pressure into the market. However, as price or as I get out of the trade, my stop loss is hit, I switch my buying pressure into selling pressure. I am not only I am not creating buying pressure anymore, but moreover, I am creating now selling pressure, and that's why the acceleration that I was mentioning before actually happens, because all those buy positions, not only they are closed, in order to be closed they need to be reversed, and that means that all those people creating buying pressure, they are now creating selling pressure. And what happens when in a market the selling pressure is higher than the buying pressure? This is we've all studied this in university, guys, or in the school. Okay, demand and offer. Whenever you were creating buying pressure, the demand is higher than the offer, and therefore price goes up. However, what happens when the offer, the selling pressure, the offer for the Euro American dollar lots is higher than the buying pressure, because we are all switching our buying pressure into selling pressure. What happens when the offer is higher than the demand? Price goes down. All right, price goes down. Price accelerate in the opposite direction. All right. That's exactly what's happening here. That's the market nature of the fake breakout strategy. Now we are actually going to move into the price pattern, the interesting, the fun part. Please, I apologize if this market psychology thing, buying, selling pressure, all this mambo jumbo was rather boring to you. I apologize for that in advance, but it's important that you understand why price moves the way it does, and I mean, you're gonna risk your money, okay? You're gonna trade your account. You may as well just know why you are taking that particular trading decision, okay? It's not just about knowing the logistics about the trading strategy. It's about knowing the understanding the nature of the strategy in itself. I'm rambling away. Okay, let's keep on with the presentation. Once price hits this level of resistance, the specific price pattern we're gonna be searching for is what's called a pin bar or an inverted hammer. All right, a pin bar or an inverted hammer is a candlestick formation with a short body. All right, and a long wick in one direction and a short wick in the opposite direction. This is an inverted hammer, or a bearish hammer. A bullish hammer would be the opposite. Okay, a long wick to the downside and a small wick to the upside. I mean, it's called a hammer because it resembles an actual hammer. Okay, doesn't it? I mean, just imagine. It does resemble a hammer. Well, that's why it's called the hammer, or in this case, since we are talking about a level of resistance, we're going to be searching for inverted hammer. Again, long wick to the upside, short body, okay, short body, and a short wick to the upside. It's important to notice that the upper wick, it's certainly much larger than the body in itself, or the lower wick. Okay. The idea here is that the candle is going to open and close below that level of support and resistance in this case. Let me actually move into the next slide presentation. Right there. Okay, this is supposed to be a hammer. Please, please forgive my rather poor drawing skills. But anyway, that's supposed to be a hammer formation. The color of the candle in itself, the color of the body of the candle, it's irrelevant. It doesn't matter whether this is a green or a red candle. It doesn't matter whether this is an up candle or a lower candle. Okay, since the body is so small, the candle doesn't really matter much. What it matters, what's important here, is to know how to note how we have a long wick breaching through that level of resistance, and how price opens and closes below that actual level. Now here's the market psychology here. Actually, let me see how to actually do this in PowerPoint. This one and this. Oops, this one and this one and this one. Let me just move it up and move it there. Apologize for that, guys. I am doing this on the fly and I do not know much about PowerPoint, so please bear with me. Alright, here we are. As I was mentioning before, price next time it comes to retest that level, the type of formation we are gonna be searching for is that candlestick formation. Okay? So, the idea here is, again, the important thing is to see how price opens below that level within the candle. Before the candle closes, price breaches above, it begins to tick above, and therefore all those people who simply bracket levels of support and resistance are triggered into the market. Bracketing a level of support and resistance means basically placing a pending order, in this case a pending buy order, few pips above the previous level of resistance in this case. So let's assume 10 pips above that level, they simply place a pending order. Now that's a very, very, very bad idea. I always recommend to not bracket levels of support and resistance because you're going to be eaten precisely by fake breakouts. As I was mentioning before, 40 or 50% of the breakouts that take place on the forex market end up being fake breakouts. So if you just trigger your entry by a pending order, just as price begins to tick above that level, well, you are gonna be chewed up by this type of fake breakouts. Okay, so please don't do that. Don't just simply bracket levels of support and resistance. In the same way that I always recommend to not bracket level of ranges. All right, the boundaries defining the range. When price is moving sideways, you can define the upper range, the lower range. Many people simply place a buy order there and a sell order there. So as soon as price breaks away from the range boundaries, they are immediately triggered into the market. Very bad idea, guys. Don't do that. Okay, don't do that. You will be eaten by fake breakouts. Anyway, so all those people who went long there, as price turns around, as the candle closes, they are already, let's assume the candle closes there, they are already sitting at a loss. All right, they enter there and now they enter long there, and now price is sitting there. They are already sitting at a loss within one candle. All right, within one candle. As I was mentioning before, they are probably feeling the heat, and therefore they will begin closing their orders in panic before, price, before risking price retracing even further and further. As I was mentioning before, people are very scared about losing money, even more so than they are happy to make money. So again, market psychology here, they will be very hasty to close their positions, and therefore, as I was mentioning before, building up on the selling pressure into this market. So once you see this type of price formation, all right, a candlestick formation breaching through the nose or the wick, the upper wick of the candle, breaching through a level of support and resistance, but immediately after, within the candle, coming back to close below that level, this is a high probability trade. Chances are the immediately next candle upon that hammer formation, inverted hammer formation, is going to be a down candle, a heavy down candle. Okay, let me just move into the next slide presentation. There we are. Chances are, whenever you see this type of formation, okay, the next candle immediately following that hammer is going to be a massive candle to the downside. All right, in the opposite direction of the fake breakout. Again, this is where they selling pressure, the market acceleration I was mentioning before, the fear. All right, this is where the fear kicks in. So you will see a long candle with a long body. This time around, it will indeed be red. Okay, it should be red. The color does matter now. All right, now. Before I was mentioning that it didn't matter whether this candle was green or red. Well, the next one, it should be red. Short wicks both to the upside or to the downside. This is going to be a momentum filled candle, and here is where we are going to make our profits. All right, that's the candle we are going to be waiting for in order to make our profits, okay, in order to make our money. So course of action here. As soon as, let me go back into the previous slide. As soon as we see this candle, we are going to be placing a sell stop order 5 pips below the low of that candle, okay, of that fake breakout candle. That's going to be our sell stop order. Stop loss, two courses of action. The conservative way is to place the stop loss above the candle, the upper wick of the candle right there. I don't do that. I personally don't do that. It's not necessary to stretch your stop loss that far. What I do is I simply mark, or I range the entire candle. I mark the 50% level, and I place my stop loss 5 pips above the 50% level. All right? That's where I place my. If that's the entire the entire range, and that's the 50% level, what I do is I place my stop loss 5 pips above the 50% range. It is not necessary, again, to stretch your stop loss all the way up there. In my experience, once your trade is triggered, price very, very rarely comes back anywhere beyond the 50% range. That's just my experience, guys. That's what I've been noticing over time, over the so many years trading forex. So let's go back into the next slide. So you get triggered there. Stop loss, that's a 50%, so stop loss should be somewhere in there. That's where it would be you would place your stop loss level. Where would you locate your profit taking target? Again, two courses of action here. If you are satisfied with your profits up on the first fear bar, the first reversal bar, you can simply close your targets. You can close the trade altogether at the close of this candle, okay, of the momentum candle. Oh, by the way, I forgot to mention, you need to wait for this candle, the fake breakout candle, to close before you place your sell stop order. All right, that's why before I was mentioning that you don't want to just bracket the previous level of resistance. You want to wait for the candle as a whole to close. If you saw a massive up bar here, all right, a massive up bar, that means that this is a momentum filled bar. Obviously, this time around, this would be a green bar. Okay, let's assume this bar happened instead of the fake breakout candle there. Okay, so if you saw a massive green bar, chances are this is going to be a valid breakout, and then you would want to be searching for long opportunities. This is not the scenario we are reviewing in this particular presentation. We're just talking about fake breakouts, but just for you to know how to read price action around support and resistance levels by the shape of the actual breakout candle. Okay, if you get a momentum candle to the upside, a momentum green candle, chances are this is happening in volume. All right, the greed is overwhelming the fear, and therefore, price will continue to push up over the following candles. In the other hand, if you see this type of hesitation candle, all right, the bar opening and closing below that level, basically price failing to close anywhere above that level, chances are the next reaction candle is going to be to the downside. Okay? No, but again, in order to determine whether we are getting a hesitation candle or a full breakout candle, full momentum breakout candle, you need to wait for the candle to actually close. Okay, you wait for the candle to close. Once the candle has closed there, then you go ahead, you analyze the situation, you see that the wick breached through that level, that price came back to close below that level, and obviously you are looking for a fake breakout scenario here. You want to go short, then is where you place your sell stop order, okay, 5 pips below that particular candle. All right, not before, guys. Wait for this candle to close. Okay, so moving on, entry, stop loss. Where is our first target? Our profit taking levels. Again, two courses of action. You can simply close the trade altogether as the first momentum candle closes for the day. All right. If let's assume you are looking into the daily time frame, well, as this bar closes for the day, that's where you simply close your position altogether. However, in my experience, you usually have momentum enough. Fear in the market upon a fake breakout usually gives momentum enough to wait for a second reversal candle also to the downside. Okay. So as well, let me actually move into the next slide. So as I was mentioning before, you usually have momentum enough for a second momentum candle, okay, in the opposite direction to the fake breakout. Now, please mind that I've printed the second bar smaller than the first one. All right, that's because fear begins to settle in. All right, the second candle usually is not as large as the first one. Again, market psychology, fear, it's something that happens all of a sudden. Okay, panic. Mass panic is something that it just lasts for so long before that panic settles down a little bit. Well, this is where most of the panic pulls through, but in my experience, again, it usually spans over a second candle, even though that second candle usually has a smaller range. But still, I mean, it's nice to have a little bit farther profits, isn't it? So again, you can simply close your trade altogether at the close of the first candle, or what you can do, which is what I personally do, that's my recommendation, that's what I personally do myself, that's the way I trade these setups myself. Okay, what I do is I close 50% of the trade at that level. I move my stop loss from its original location down to entry levels plus the spread. Basically, I trail my stop loss to break even, and then I simply close the remaining 50% of the trade at the close of the next candle. Okay, regardless of whether this second candle is to the downside, is to the upside, or it simply remains flat. Okay, we have this kind of candle with a short body, both to the short body, basically price opening and closing around the same level. Wherever that second candle closes, at the close of that second candle, indeed, I close the remaining 50% of the trade. Okay, recapping a little bit: entry, stop loss. I close 50% there, and I move my stop loss to break even, and then 50% at the close of this second candle. Okay, that's the way I personally trade this type of scenarios. Okay, this type of fake breakout strategy, and that's just the way I recommend you guys to trade it. Just please give it a try. What else? Oh yeah, let me go back one slide. It's important to notice or to remember that you want your entry to be triggered by the candle following immediately after the fake breakout candle. Okay, again, this is a momentum strategy, momentum field strategy. We are trading mass panic. And panic is something that happens in a rush, it's something that happens momentum, it's something that happens all of a sudden. If there is no mass panic, this strategy is not going to work. Okay, I must repeat that. If there is no momentum, this strategy is not going to work. So, by definition, you want, as soon as this candle, the fake breakout candle closes, you place your sell stop order there. If the bar immediately following the fake breakout candle does not trigger your entry point, you want to cancel that order. All right, actually I have one slide here ready for you. If upon the fake breakout you place, once that candle closes, you place your sell stop order there, okay, 5 pips below the low for that candle. If after that what you get is another shy candle with a small body, butting around breakout levels, that level of support and resistance, and then you have another candle just flapping sideways around that level, your entry is still not triggered, and then another one, again, just, price not really going anywhere, the market is still undecided, it's not really ready to either, pull through with the actual breakout or giving us a fake breakout altogether. If the market is not ready to move into any direction, you do not want to be ready yourself. You do not want to try it. There's something that you've got to understand here, guys. And again, I'm afraid I'm gonna get all theoretical again. But if the market is not giving you any directional hint as to which direction you want to try it, then you don't want to try it yourself at all. You're not a market leader. You're not a market leader. I mean, I am not a market leader either. The only market leaders are, again, people working for big investment funds, trading institutions, investment banks, that kind of people who, again, trade hundreds upon hundreds upon hundreds of lots per position. Your or my 3 lots, my 10 lots, our small orders, us retail traders with our small orders, we are not going to move the market. We have no impact whatsoever on the market. So you need to wait for the market to begin moving before you consider taking the trade, because you cannot move the market by yourself. If you enter the trade before the market is moving, you're gambling. You need to wait first for the market to move, and then you follow along. That's exactly why I mentioned before, you don't want to bracket levels of support and resistance. If you just trigger your entry as price simply ticks a few pips beyond any particular level, you're assuming that you can move the market. You cannot move the market. You need to wait for the market to hint the next directional bias, in this case with a fake breakout signal. The reversal move, you need to wait for the market to hint the next move before you consider taking the trade. All right. So if the market as a whole keeps on batting around that indecision taking level, that level of support and resistance, without actually giving us any clue whatsoever, price is simply flapping sideways, you want to cancel your entry. That's not the type of trading condition you want to trade under. All right, that's not the market scenario you're going to profit from. In fact, if you trade under this market condition, trust me if I say, in the long term, you're going to lose money. You can make some pips once, you can make some pips twice, but eventually you will see that your win-loss ratio is just not going to be acceptable. All right. So again, sorry for the rambling, guys. If price keeps on moving sideways, you cancel that thing. You cancel that sell stop order. You want a must-have requirement is indeed that your entry is triggered within the next candle immediately following the breakout candle. All right. I hope that was I drove the point home here. And well, I believe that's pretty much all, really. Oh yeah, before I forget, there is just one single exception as of where, let me go back into the previous slide. One exception when you will not cancel your sell stop order if the candle following the fake breakout signal does not trigger your sell stop order. One exception where you will not cancel that pending order. And that's in case you get another hammer, another second hammer in a row. Actually, I have another slide precisely for this type of scenario. If by the time you saw this candle closing, you place your sell stop order, and then the next bar is actually a second fake candle, all right, where price once again opens below breakout point, okay, below that level of support and resistance, again gives us a second push in the direction of the original breakout, but once again it fails to break above that particular level again. Basically what we get is a twin fake candlestick formation, all right, a twin hammer formation. You are still okay to keep that that sell stop order in place. All right, you are still okay to keep that second hammer. That sell stop order once that second hammer closes. What you want to do is to simply readjust your entry and to place it below 5 pips below the second hammer. All right, just like that. 5 pips below the second hammer. You're doing nothing but simply readjusting your entry point, okay? Obviously, the stop loss would also be adjusted, so you need to take the 50% of that second candle, right there, place it 5 pips above that level, and again tweak your adjust your entry point as per the second fake breakout candle. Okay, but again, we are still seeing fake breakout signals. Okay, as long as we keep on seeing fake breakout signals, no reason to not believe that the next momentum move is going to be to the downside. Okay, we are not looking into this scenario with candles with small bodies and small wicks flapping up and down breakout points, okay, breakout levels. We are not looking into that. If that happens, you do indeed cancel that pending order. On the other hand, we are looking into this. We are getting consecutive fake signals, and therefore we must still believe that fear is going to kick in the market sooner or later, and that the next momentum move, the next significant move, is going to be this one, and then hopefully this one for further profits. All right, and now I do believe I've covered pretty much everything as far as the theory goes. I do apologize if I overstretched this theoretical presentation a little bit too long, but fear not, we are now ready to move into the fun part. We are now ready to move into actual forex charts. We are going to be now looking into different different actual charts, currency pairs, where we will spot this type of this type of market conditions, of market scenario, and I will pinpoint for you when exactly to enter the trade, when exactly to place your stop loss, and how we would go about exiting the trades. Okay. Give me a second. I should have some charts ready here for you. Just a second, guys. Where did I leave my charts? Oh, there they are. All right. I'm going to show you different examples now on different currency pairs. Now we are looking into the sterling pound against the Japanese yen on the 1 hour time frame. But like I say, I'm going to show you different examples on different currency pairs and different time frames. Well, quite frankly, just to prove that this strategy works on any time frame and any currency pair. At the end of the day, we are trading market psychology here. Okay, fear and greed, and those basic principles, those basic price action principles are universal across the board. Okay, so indeed you can find them on any currency pair, any time frame. I personally like to follow them on the daily time frame, okay, on the longer time frames in general, daily or weekly, but you can find them anywhere. All right, okay. Sterling pound against the Japanese yen 1 hour time frame. As we can see, we have a prototypical zigzagging pattern. Okay, price uptrending in this particular chart. Obviously, that being the top of the trend before the breakout. Okay, before the breakout. So certainly that's a key level where, well, we would mark. I'm gonna mark it in deep red. All right. Right there, signifying a key turning point in the chart. We have obviously another one there, the beginning of the chart, and also another one there. I mean, the beginning of the trend, and another one there, the beginning of the pullback. Okay, the end of the pullback actually. This pullback I'm talking about. So we could certainly mark those levels as key support and resistance level. But as we scroll forward, I want to focus on this one here. Take a look at what happens. Price pullback. Okay. Pulls back a little bit, then the pulls unleash another attack to that level, to be more specific, the 143.00, and see what happens there. See what do we get there once price retests, or the bulls unleash another attack to that level, aiming to score new highs. All right, on this trend, what do we get there? That's a fake candle formation. Okay, sorry, a fake breakout candle formation. Prototypical fake candle, fake hammer breakout formation. Price opening and then moving up, probably triggering a number of orders in there, buy orders there, and then coming back down to close below that level. What do we see right afterwards? Two momentum mass panic sellouts. Okay, remember, we are trading here panic sellouts, and that's what we get. This is the first candle I was talking about before. I was showing you in the presentation. This is the second one. All right. Second candle, as I mentioned before, we usually have momentum enough for two different candles. As soon as this candle closes there, we would go ahead and place our sell stop there, 50% of the range, somewhere in there, stop loss few pips above. All right, entry at the close of this candle, we would move our stop loss to break even, and then we would close also we would close 50% of the trade, and then we would close 50% of the trade as the second candle, this one there, closes for the day. Okay, as you can see, two long candles. Usually, as I was mentioning before, this one is a little bit smaller than this one. It's not the case in this particular example, but usually it is. All right, so prototypical example, upon the fake breakout, two momentum moves in the opposite direction. Beautiful example. Okay, let me show you another example. This time around the Kiwi, similar setup. Kiwi, the New Zealand dollar against the American dollar on the 1 hour time frame. Another uptrend. Okay, finally the trend comes to an end with multiple levels of resistance at the multiple individual bars topping out at one particular level of resistance. Certainly that's one level that you want to mark in your chart. Again, you see that 1, 2, 3, 4 times price attempted to break above that level, and well, it just couldn't. Okay, that's the 0.73 level to be more exact. So okay, there we keep on scrolling forward, and there we are. Let me zoom in a little bit more. Next time price attempted to break through that level, you see what we got? What's that, guys? What is that? Another fake breakout signified by that individual candle, okay, by that individual inverted hammer. Entry, first target, second target, okay, stop loss somewhere in there. Prototypical price action, two consecutive momentum down bars upon the fake breakout to the upside. Again, very prototypical event in the forex market. Okay, let me show you another example. Australian dollar, the Aussie Australian dollar against the American dollar on the 1 hour time frame. What do we have here? A clear downtrend, price zigzagging down, eventually bottoming out at that level. For the time being, the end of the trend. Okay, end of the trend right there. Certainly a level of support. I'm going to show you an example as a fake breakout to the downside that eventually turned around to the upside. Just to show you different examples to you guys. Okay, so we keep on scrolling back, and what do we have? The bears unleashing another attack to that precise level, 0.8950 to be more exact. And what do we have here? Do you see that? And actually, let me zoom in a little bit more and scroll forward. There we are. What do we have there? A fake breakout. Okay, a fake hammer formation. This time around is not an inverted hammer, but a regular hammer, since it's a bullish reversal formation. Well, price opening and closing above that particular level of resistance. Very typical. And as a consequence, the next two consecutive candles, what do we have? Two momentum moves to the upside. Okay, first target, second target, prototypical stuff. Okay, let's search for another example. Oh, by the way, this was the 4 hours time frame. As you can see, I am going up in time frames just to show you guys, again, to prove that it works on any time frame. Okay, let me now show you an even longer time frame, the sterling pound against the Canadian dollar on the daily time frame. Okay, whoops, swing to the upside, pull back, comes up. We can mark that as a level of resistance, fake breakout, two consecutive candles to the downside, isn't it? But here's what's funny. So we would mark this level, okay, as previous level of resistance right there. We got the fake breakout, we got the trade there. All right, now we have a new level of resistance, don't we? A new high on this particular currency pair. So what I do is simply adjust my level of resistance from there. Now let me zoom out a little bit more and see what happens there. What happens is a double, actually triple, okay, triple attempt. Do you see those long wicks to the upside? Those, remember what I was telling you guys before, that sometimes you get multiple candles in a row signifying that fake reversal hammer formation. All right, sometimes you just get one, sometimes you get a few of them. Well, this is a perfect example. Not only we got the first example of this particular strategy in there, okay, with those two consecutive long candles to the downside, we mark the new level of resistance, and just immediately after, the next time around, price tried to breach above that level. Price opens there, goes up, fails to close anywhere above, and comes back to close down or below that level. Again, open, rally, close below that level. Open, rally, close below that level there, and as a consequence, momentum, massive panic to the upside, to the downside. All right. I mean, this type of stuff does happen. That's why I wanted to show you guys this strategy. It happens, and it happens more often than you would expect. As I was mentioning before, 40–50% of the breakouts you will find are fake breakouts. Fake breakouts. This is not something that happens in a blue moon, okay, guys? It does happen, and it does happen often. So please, please, please search out for these fake hammer breakouts, and whenever you spot them, try to spot the trading opportunity, the entry opportunity in the opposite direction. Well, now let me show you another example. Remember when at the beginning of the presentation I was stating that this type of strategy works not only on horizontal levels of support and resistance, but also on trend lines? Well, here's a perfect example. A euro, by the way, we are looking into the euro against the American dollar on the daily time frame. Let me draw a trend line from the beginning of the trend right there. Okay, let me extend that just a second. Trend line properties, Ray. All right, there we are. See what we get there? What do we have? That's a twin fake breakout of a trend line. Do you see those two hammers in a row? First hammer, second hammer, breaching through the trend line, making it look like the trend is going to come to an end. Okay, if I just draw the outer trend line here, all right, in this particular trend, okay, it seems like price is going to break to the upside. Eventually it gives us not only one fake hammer, but also two in a row, and eventually after that, what do we have? Two momentum bars, okay, to the downside. 1 and 2. This time around we can certainly see how the second one is a little bit smaller than the first one, which again, it's usually the case. But anyway, I just wanted to show you guys how those fake signals, once breaking, whenever they break, or they falsely break through a level of support and resistance, can very accurately hint us in the direction of the immediate next move. In this case, obviously, to the downside. All right. And I reckon that's about it. I have plenty of other examples here prepared for you, but this video is already running too long, and well, I believe the concept is clear already. Okay, it's just now it's time for you to go back into your charts, begin drawing those key levels of support and resistance, and if you find price giving you that fake signal, you will see how more often than not you should see the price moving in the opposite direction right away. And well, that's pretty much it. It's time to wrap up the fake breakout strategy. I hope you enjoyed it. Again, please search for this type of reversal patterns around key levels of support and resistance because they are quite profitable.